Keep it up, Mick. You know, gotta make it. You can't quit. Middle of the fourth quarter. All right, so before we get our panel up here, a couple things. Note Servicing Center had done a raffle at their booth for a $35 Starbucks gift card. So if Aaron Quinn is here, I have a gift card for you. If not, they said Bob could use it. Right? Aaron Quinn, are you here? Well, we will get that card to her. Right. I love Starbucks. Anyway, and don't forget, we do have a bonus preview at 4:30. You get one of these Eddie books. It's a whole new ball game if you're there. Our next panel, and Charles, if you guys want to make your way to the stage. Our next panel, Charles Mangan is going to moderate that. And he's going to have a lot of vendors up here. And there's different ways to scale your business, okay? One way, obviously, is to outsource by using vendors that you met in the exhibit hall. A lot of people use VAs. How many people have used VAs? Virtual assistants. And sometimes you use interns. How many people have used interns? Well, it kind of goes down. The outsourcing vendors is going to cost you more than the VA or the intern. So what I want to do right now is to recognize that bottom rung. All right, so we have a prize for what we've named the Best Unpaid Intern of the Year, Kevin Big Daddy Berry. Come on up from Moat Management. Borrow a stick, Mike. All right, Kevin is 22. He's been working with Mike Powell and Mitch Stephen. And this is his first NoteExpo. Come on, Big Daddy. I won't put you on the spot too much. Just tell everybody what you thought of your first NoteExpo experience.
It was amazing. Amazing.
He's a man of few words. Here, hold that right there. We're going to get a picture. All right, you guys give Kevin a big hand.
Thank you so much.
All right, Charles.
All right, let's do it. Good afternoon, everybody. Before we get started on our panel this afternoon, I'd like for each of our panelists to introduce themselves.
I'm Nance Rahzel. I'm with SN Servicing Corporation based in Eureka, California. I've been there 21 years. I'm currently the Service Transfer Coordinator and New Investor Setup Relations.
I'm Melissa Bowling. I'm the Loan Servicing Manager and President of Allied Servicing Corporation out of Spokane, Washington. Been around since 2004, and we handle multiplicity of assets for our clients.
Hello, I'm David Chen. I'm a partner at Activist Legal. We provide single point of contact legal services, default services across the nation, every jurisdiction, except for North Dakota, South Dakota, and Hawaii. And it's a wonderful business.
Hi, I'm Russ O'Donnell, founder of Call the Underwriter, and we do Dodd-Frank compliance underwriting nationwide, and we help seller finance investors stay compliant.
Thank you. So as you can see, we have a variety of panelists up here today, and I get many questions from our investors on a regular basis. And so today, our panelists, we're going to cover some different topics. They won't all just be servicing, but I thought they'd be great topics we could cover. So one topic I want to start off with is the servicing transfer when you're boarding or servicing an asset. So when you're transferring that servicing, we often refer to that as the boarding of the asset. One question I get most frequently is, why does it take so long to board a loan? When we say board, you think, okay, it's one step. How long could that take? Actually, it's not a one-step process. It's a several-step process. And there's a lot involved when you're boarding that asset. So couldn't think of anybody else better than boarding an asset than Ms. Rahzel here. So Nance, I'm going to start with you. Can you walk us through that process, or the steps in those processes of boarding that asset?
So the steps are for the selling investor and the purchasing investor to communicate with their servicer that they have bought or sold a loan. Big step.
Big step. And make sure you've got that account set up prior to the servicing transfer.
Right. The servicers then communicate with each other and establish a service transfer date. That has to be out a minimum of 15 days from the notification the releasing servicer sends. That's the RESPA letter, goodbye letter we call it in our industry. Then the two servicers begin their communication of transmitting the data, the files, the images. The goodbye letter itself is approved by both servicers before those are mailed out to the borrowers. In that we call the interim period. So funds may still be collected by the releasing servicer, held, and then forwarded to the new servicer after the transfer. That transfer date, then the releasing servicer would communicate the final data, the balances, the next due date, any changes to the borrower's information, in loss mitigation or loan modifications that are in process, whole realm of information they're going to communicate to that new servicer, who then boards the loan on their system, which is when it goes active, and they begin their collection efforts on your behalf as the new investor.
Okay, good deal. So when boarding an asset, what are some of the biggest delays that you come across, Nance?
Not receiving the information in a timely manner, or not receiving everything that's required. Nowadays, we see missing payment histories, maybe a copy of a modification that happened throughout the term of the loan. Not all loans are newly originated, so they may have been around 5 years, 10 years, so there's been a lot of activity on that loan during that time. So just making sure that in your due diligence, you've reviewed those documents and made sure that they are all current in the file that's going to be presented to your new servicer.
So the loan information, or the UPB, next due, all the primary data comes from the previous servicer.
Right.
But such as like modifications, who provides you those modifications?
The releasing servicer should have an image of that.
Those documents.
So those documents are part of what's provided by the releasing servicer
Okay.
to the new servicer.
And what documents do you require in order to board a loan, to get the loan boarded?
Different servicers have different requirements, but in general, it would be a copy of the note, a copy of any modifications, a copy of the deed of trust or mortgage. Some like to see a title policy. The original application nowadays is part of it, and the payment histories. Those are extremely important. My company, we do a lot of non-performing servicing, so when those loans go into foreclosure, those are the things that they're looking for in the court system. Also, borrowers who have bankruptcies, any of the detail as far as their bankruptcy. So it's whatever is relevant to that particular loan.
Okay. And interim payment. So I buy a note, I'm transferring it from servicer A to servicer B, and the borrower makes a payment. Okay. How is that interim payment handled normally?
The releasing servicer would hold that until the transfer date, at which point they communicate to the new servicer that they have that money on hand, and then they'll wire it or send a check, as well as any funds that are in escrow impound that they might have, or if the borrower had other funds that hadn't been posted to the account yet. All of that is sent then at the transfer date. That's the interim funds.
Okay.
And then they're credited at the new servicer and the information updated on the borrower's account.
Okay. And Melissa, is that pretty much how you handle it on your servicing transfer on your end?
For the most part, I'd like to add that there are some servicers who don't transmit images or documents. So at Allied, we really rely on the investor to provide us either a full copy of that collateral file or the collateral file itself if we're doing your document custody. So just to remember, the documents need to come from you in time with the data that we get from the servicer so that we can board that loan quickly, and then we can do the QC that says the data we got matches the documents you have and there's no missing items. A lot of times that QC is where we discover that there's a modification that's missing because the servicer was servicing it at X terms, but the only documents in the file are Y. So it's very important to then bridge that gap and figure out why they don't match. Because we, as servicers, have to justify our setup documents or our setup data to the borrowers if they were to contact us. And every servicer handles interim funds a little differently as well. Some of them will send them to whoever their customer was, and then that your seller will then need to forward on to you. Some of them send them to the servicer, and then we have to forward them on. It just really depends on your servicer, so it's good to ask the seller for their servicer's policies and procedures so you know where those interim funds go and when you can and from whom you can expect to receive them.
Okay. And don't worry, if I receive your interim payments, I'll be glad to take them. And believe me, I have received some of your interim payments, but we'll send them to you. So Melissa, let me ask you, when you get a new loan boarded, what are some of the first steps you do right out of the gate when you board that asset?
Okay, so once we've gone through the QC of documents versus data, we do a bankruptcy check on every loan. We were doing it just on non-performing, but now we're finding some performers, so they're post Chapter 13 or Chapter 7 that are performing. And we found, we need to know that, we need to tag that because it changes all of your collection efforts and how you treat them. So we check the taxes, we check the bankruptcy, we look for insurance coverage. If there isn't insurance coverage, we will talk to the prior servicer, see if we can get a copy of coverage. We may contact you. Allied sends out a boarding confirmation email. It goes to the investor, it tells them their loan number, it tells them anything we're missing from the file that we need to get. Even if it's just entity documents, sometimes we're missing your W-9 or your disbursement instructions. And that's the opportunity to get the file in order so it can move forward. We also, in some cases, handle the recording of the transfer documents for our clients. So if we've gotten the collateral file, we'll do a review, make sure everything is in order and chained, and then we'll go ahead and record those documents. But really after that service transfer period, which is we have 15 days to load your loan. That's all we get, and then our hello letter has to go out. That's why it's so important for the clients to be responsive to our requests so that we can get that loan boarded in a compliant manner, get the hello package out, and hopefully start those payments coming in from the borrower or opening the door for the conversations with your non-performers.
So when you're dealing with a delinquent borrower, how important is it to build a rapport with that borrower from the first time you speak with them on the phone?
It's actually the most important part because most borrowers are either they really don't want to deal with the delinquency or they're embarrassed by it. And so being able to draw out their story and hear how we got where we are, and then look at some positive steps to moving forward is really very important. I am very lucky that I have a collector who can get anyone's story out of anyone. And it's great because then they feel comfortable that when we send them the application, that application is going to be taken seriously when it's returned. So it's super important to try and just listen to everything they have to say about how they got there. Many times it just sounds like excuses. It's really difficult to listen to because I hear the same sorts of stories every day, but you have to give it credence for each borrower. You have to really work them around to the point where they're willing to talk about resolution as opposed to the problem.
Okay. And how hard is it, or can you give us tips on keeping borrowers engaged? Is there anything you do that may keep a borrower engaged?
I think making the workout application process as simple as possible. Our application happens to be 2 pages, and we have a checklist that goes with it of the documents they need to return. So you want to make it easy. You want to make it easy for them to get it back. When you ask questions about the things that are missing or odd, you really have to style it in a manner that they don't feel like they're being attacked or accused or you're hiding something. They usually are, but you have to try and ask it a different way. And it's really, you need to keep them up to date. And the decisions have to be made quickly. So we give them 2 weeks to return their application. When our clients take 45 days to respond to the request for review, we've probably lost that borrower. We can't get them back. They've given up. So prompt response from the investor helps us communicate and get that modification package out to the borrower. We talk to borrowers too whose only option is going to be deed in lieu or short sale or foreclosure, and it's just a matter of educating them, making sure they understand how the process will work, what they can expect going forward, and just continuing to be available to them and to be open to them. Honestly, we found that most of our borrowers will establish a relationship, if you will, with the first person they talk to.
Right.
And then they're going to want to talk to them, and making that person available to them also helps. It helps a lot if there's not confusion. If you want to do your borrower outreach, make sure your servicer knows that you're doing your borrower outreach so we're not also doing it. Because getting 2 calls from 2 companies is extremely confusing, and that's where they start to feel, oh, now I'm being harassed, and now I'm being chased down, and I'm not going to talk to anybody. So that would really be my advice in that situation.
So that kind of brings up my next question, because I was going to ask you, what are some things that servicers frown upon? And you brought up a good point, the investor contacting the borrower, and technically when the servicer boards a loan, the servicer wants to make contact, but if you're making contact with that borrower, that's probably something that's frowned on in the servicing industry. You shouldn't do it. Your servicer, that's what you pay them for, is to make the borrower contact. We
recognize that it's unlikely that all of our clients are never going to call their borrowers.
Really?
Yes. I am a realist in this industry, and that is fine. And some of what Allied has done is create an a la carte kind of program. If you're going to do it, just tell me. It's easy enough for us to put a mark on there that says the investor's handling the borrower outreach. So we're the accountant, we're dealing with any payments, we're still doing our insurance thing and our tax thing and anything else, but we're not actually calling your borrower. If you start foreclosure, let us know. We have to restrict the account so we don't accept payments when you're halfway through an action. When you take the property back, let me know. I have had clients tell me after they got their year-end notice, I foreclosed on that 9 months ago. Okay, well, you now owe me an additional so many months of service fees because you never told me. So our tax reporting is wrong, our system is wrong, we may have been making phone calls. It's so important if you're going to take on any of those roles that your servicer will do for you, that you are actively communicating back to them what you're doing, what steps you're taking, who's your attorney, copies of your pleadings. If you're doing your own bankruptcy, same thing. Get me the filed proof of claim. If you file for relief, get me the order. I have to be your partner. I can't be the last person you think of. I think for SN,
we frown upon our investors communicating with the borrowers. In fact, that's part of your servicing agreement with us, is that you don't communicate with the borrowers. We're the ones holding the licensing. We're the ones that are obligated to do that on your behalf, which is why you hired us in the first place. So
every servicer's
but the
got
communication with your servicer, that's your main purpose for us, is the open line of communication. And so on each individual account, and you probably have a contact that you set your account up with. If you have questions, just go to them and ask the questions. Don't try to sidestep dealing with your servicer.
Make sure you understand your servicer's policies, because some are adamant, do not call the borrowers, and others, they have kind of a la carte, like Melissa and Allied. So, and if you're still, even if you're doing Melissa's model, you're calling your borrowers, just make sure you notify them, shoot Melissa, Sheila, Jim, somebody an email, just let them know that you're contacting the borrowers. I mean, I'm guilty, I contact my borrowers all the time. So, I think I forgot to email you, by the way. But anyways, just saying. Sheila, let me ask you a question. Melissa, I've got Sheila in my brain now. Melissa, let me ask you a question. How important is it that the investor, when they're buying a note, they understand the documents, the collateral documents? They know what they're recording, they know what needs to be filed. How important is that?
I think it's very important because there are assets out there that must be handled differently because of what the documents are. Obviously, land contracts have been a big product. but they are handled very differently from certain foreclosure standpoints than others. The documents are different. If the land contract is unrecorded, some of the documents won't be recorded. There may or may not be a note. But even standard, I'm seeing bank assets coming through, so standard mortgage deed of trust. We recently had a client who didn't realize or recognize that it was an ARM. And they were then taken aback when we made the adjustment because the borrower complained. And it was an unfortunate situation all around. It's so important to read them. And if you're not 100% clear on what's going to happen, you know what? Call your servicer, call your seller, call your mentor. There are so many resources out there who are more than happy, shoot me a copy of that note and say, hey, I don't understand what they're doing here, or is this part of this land contract even enforceable? Just give us a call and ask, because it's critical that you and your servicer have the same understanding of the documents and how you're going to proceed under them.
And we see this all the time. We'll get to a point where we're getting ready to refer a foreclosure out, and oops, the attorney pulls title and there's a break in the chain of title. It's because somebody recorded an assignment of land contract on an unrecorded land contract. Or, just make sure that if you're unsure what you're recording or what needs to be recorded, contact your servicer, contact us. There's plenty of sources there. You just need to make sure that you know what you're recording, because it will mess up the chain and it will cause delays down the road, which leads me to you, David. So David, let's start off. Probably the number one question I get when I am talking to students or investors is there a way to reduce the timelines when you're foreclosing on properties? And I realize we're talking about the United States in general, but everybody has different timelines, but in general.
There are some ways to reduce the timeline. I think one of the most important things that the servicers really touch on is having the proper paper. In order to foreclose, we need to prove that you have the right to do so and that there's actually a debt. And in order to do that, we have to provide a payment history, a payoff. We have to demonstrate there's amount due, and we have to identify who's the individual that is allowed to foreclose. So we have to have a complete assignment chain and a note. There are ways around it, and I always tell people, look at your paper, make sure you check it, and if there's a problem, let us know. We can find a way around it, but it will cost time, and we will manage your expectations as to that. The other two things that always cause delays that you can reduce on is communicate with your attorneys. Some servicers, we have different arrangements, but in general, our counsel and myself, we contact and talk to our investors directly. We're here to help you out. We're here to answer questions, and we're also in need of your responses, because a lot of times we'll provide settlement offers. These things do not sit on the table for a long time. A decision needs to be made. And if we don't make a decision, it makes us look bad in court, makes you guys look bad in court, and cause a whole host of other problems. And finally, in regards to communicating with your attorney, the other way you can reduce time is knowing what you want. We're trying to get loss mitigation done in a lot of these cases, and having an investor that knows how much they're willing to take, what they're willing to concede to, is very helpful when they calculate the risk in advance, because we can offer what you're willing to take, and instead of a lot of cases trying to determine how much they can possibly pay, and you can get a deal done a lot more quickly.
Right.
And that's, time is money. That reduces time, reduces costs for everybody.
And I know this next question, it's a very common question that I get, and it's when you're preparing your reinstatement figures or your payoff figures in a foreclosure, or you're preparing for the foreclosure sale, what can you include in that reinstatement? And again, that could vary. I understand that.
I'll make a disclaimer. I am a DC attorney. I can't answer for everyone. But what I like to say with regards to, we send out surveys to our attorneys to find this out all the time. It's important for invoicing, what's recoverable and what is not. There are certain jurisdictions in the United States where you're limited on what you can recover. For example, in Michigan, you can only recover $75 for attorney's fees. That's a cap. In DC, you can't recover mediation costs in a non-judicial foreclosure. And in Ohio, you can't recover attorney's costs if you are paid off or if you go to foreclosure sale. However, if you're doing reinstatement, you can add your attorney's fees. So these little differences, vary a ton, and we always, recommend that you talk to your counsel about and ask. The other thing is, but beyond that, generally most fees are recoverable, and it's really governed by your deed of trust or your mortgage and the provisions in it. And I highly recommend, if you've never read one, read that thing. It's super boring, but you get to see some of the specific wording, especially in a general Fannie Mae mortgage, what you're allowed to recover. And with regards to attorney's fees, I should point out this does not include things like assignments. You can't recover for assignments. You can't recover for substitution of trustees or title curative, because these are things that you would have had to do regardless, that benefit your interest and not necessarily the borrower. So I would always ask an attorney and look at your mortgage, and feel free to ask questions anytime.
So no preservation cost if they have preservation costs, like securing and...
There can be preservation costs as long as it's in your deed of trust. And your deed of trust will have provisions that specifically say that you can recover these things when they're in default. But it depends on how it's written. And these things vary across the United States, and they vary within the jurisdiction itself. So you got to be careful. So know your documents.
Okay.
And bankruptcy has the same issue. There are some fees that they're simply not recoverable from the debtor during the bankruptcy. Proof of claim is a famous one. There's a lot of times you can't get that. They're not going to pay it out. So that's a legal fee that you have expended that you may not get back. So, it's important to understand and recognize that. If they get dismissed, all bets are off now. They may indeed owe it to you. But when they're in the bankruptcy, it's possible you'll get to the end. They will repay every dollar except that fee, and at that point it has to be waived off. So just be aware.
Okay. And David, is that generally the biggest delay you see is when somebody files a bankruptcy? Or is that the biggest delay you usually see in a foreclosure process is when they file a bankruptcy?
It's one of the delays. I think the biggest, most common delay is actually service. It can take a lot more time than people expect. It's sometimes very hard to find a borrower. And in some jurisdictions, you can't do alternative service. You got to serve them personally, or the judge isn't going to allow you to take the home away. So, or they'll require you to do it for 90 days, stacked on 90 days, 3 times. That's a lot of 270 some days before you can even foreclose. Even worse, if it's an individual who's deceased and you have to open a probate case. In the District of Columbia, that can cost you $10,000 in 10 months. So, when that comes up, talk to your attorneys, ask, complain, and we will do the best we can, but sometimes we are limited to what the court can do.
One more question for you, David. Based on your experience, what percentage of foreclosures actually sell at the courthouse steps to a third party?
A couple of years ago, I would have told you 1 in 6, 1 in 5. I deal mostly in more scratch and dent paper and stuff that has issues, so we deal with a lot of problems, and low value properties, so we see more around 1 in 10. But again, this can be mitigated if you calculate it into your bid. I mean, if you lower the bid, you're going to get more sales. It just depends on what you want and knowing what you want.
Okay. So if you're not that 1 in 6, then we're going to own a property. We're going to get that property all spruced up and ready to resell and do some seller financing. So we're pleased to have you today, Russ. Let's talk about the seller financing a little bit. So there's a misconception, Russ, that as long as you have an RMLO when we're seller financing, that we are SAFE Act compliant. But there's more to it, I believe, than just the RMLO service, correct?
Man, that's probably the biggest question that we get is when we're talking to a new investor. And I mean, when I say new investor, I mean new to us. They can be seasoned, they can be, right out of the box, right fresh out of note school and ready to rock. And so if we like to explain it this way, that there's 2 things you have to be compliant with, and the RMLO requirement comes mainly through what's called the SAFE Act, and the SAFE Act was enacted before Dodd-Frank, and it governs when you have to use an RMLO, who can originate mortgage loans, who can't. And the other side of it, Dodd-Frank, has more to do with verifying a buyer's ability to repay. So we look at it as origination and underwriting. And so when people are under the belief that, well, as long as I hire an RMLO, I'm covered. They told me to hire an RMLO. I hired an RMLO. I'm good. I'm compliant. The trouble with that is that RMLOs are not underwriters. And RMLOs are loan officers. They're salespeople. I'm one of them. But I also happen to be a HUD certified underwriter. And I can tell you that RMLOs don't know guidelines. And you need somebody who knows guidelines to make sure that that borrower has the ability to repay. In a recent assessment that the CFPB released after their, and by the way, the CFPB has released a guide back in 2016, it was last amended in 16, on how to comply with the ability to repay and what Dodd-Frank means. They took all several thousand pages and combined it into less than 100 pages on how to underwrite your loans. And so in January, they just issued an assessment on how things are going, how, what does the future look like for Dodd-Frank, and the bottom line is the director said, we love it, we love what it's doing. Here's 37 graphs and charts to show you that it's working, and we like it, we're going to continue. And what they said was they finally clarified how underwriters need to underwrite income, and we have to use FHA guidelines now. That was never clarified, but now it is. So my point is that, not to make it so complicated that you don't want to do this anymore, is that hiring an RMLO doesn't resolve the fact that you have to underwrite that deal. Well, Russ, but the SAFE Act says I can do up to 3, assuming that your state level SAFE Act doesn't have an overlay. I can do up to 3 without an RMLO. Perfect, let's say that you're right. You still have to underwrite that deal, even if it's the very first deal. You have to make sure that that borrower meets ability to repay.
So even if it's within the 3, under 3, they still have to have a certified underwriter to complete that underwriting?
Great question. So we recommend a certified underwriter because an underwriter knows how to underwrite income and make exceptions and when you can and when you can't. The CFPB, their guideline is that if they're in front of you and they're asking you, hey, the borrower has said that you didn't meet the ability to repay requirement, you never verified that they could afford this payment. They're going to ask you a couple of questions. Number one is, what underwriting methods did you use to determine ability to repay? And so that doesn't mean that you have to hire an underwriter. That means that you can underwrite the loan yourself. It just, how risky or how risk averse are you? Do you want to hire one at a cost that's a normal loan cost that the buyer can pay for and have it done professionally, or do you want to do it yourself? You don't have to hire somebody, you can do it yourself. The second question they ask you is, how did that borrower pay? How did the loan perform for the first 12 months after it was consummated or after it was funded? So very important.
Okay. Well, they have changed those guidelines. We used to just require them to be breathing. As long as they were breathing, we made them alone. So
that is on our checklist. That's on our underwriting checklist.
Now, can the RMLO also be an RMLO and an underwriter, or is it two? I mean, it's 2 separate certifications, but can the RMLO do both of those as well?
Yeah. So this is an excellent question. I was at had a really wonderful conversation with several investors at lunch, and we were talking about that. One guy was saying that, wow, I have an RMLO doing all of our transactions, and he or she's charging me about $1,000 per transaction. And I said, well, is your RMLO doing these few things? Can you open your collateral file and can you see line by line how that RMLO calculated income? If they made exceptions, under what pretense did they? If there were compensating factors that allowed the exception, how did they? And then most importantly, did they calculate residual income? The CFPB in black and white has said that an investor's golden ticket to winning the argument over ability to repay is to make sure that the buyer had what's called residual income prior to consummation. And you have to calculate that, and there's a way to calculate it. Now, residual income in underwriting doesn't mean the same thing as residual income when doing notes, okay? What it means is did the borrower have enough net income, because debt to income ratios are done on gross, right? We know that when you're qualifying for a mortgage loan. Your LO says, hey, you're at 43%, you're at 55%, it's a problem, it's not a problem. What residual income says is hey, after you back out federal, state taxes, after you back out daycare expenses, after you back out home maintenance expenses, does this borrower have enough to feed the kids, feed the cat, walk the dog, and really make this payment and live? And so on every single file, we do that. to make sure, because if the CFPB comes knocking, right, and the borrower says they didn't verify that I could pay it, they're going to ask you, did you verify? Let's see your residual income worksheets, because that's the only way that a borrower can either win or lose that argument.
So we deal with a lot of land contracts for us in our business, and I get a lot of requests or questions regarding converting these land contracts, and we do that ourselves. We convert these to notes and mortgages. Some just we do it, some of the borrowers request us to do it, so we'll convert them. If we're converting a land contract to a note mortgage, do we have to have that underwritten again by a certified underwriter?
Great question. So we haven't seen anything in Dodd-Frank or the CFPB's guide that says that if you're simply creating a new security instrument, one that replaces the existing security instrument, that you have to have that file underwritten. And if you're not, it's like a modification, okay? Modifications are exempt from Dodd-Frank. And it's because you're not raising the amount of monthly payment. You're not increasing the amount of obligation monthly for the borrower. And so in the same sense, when you're creating a mortgage note and a deed, unless you're raising the bar for the borrower, you're increasing that payment, then we haven't found anything that says that you need to hire an underwriter or have that deal underwritten.
Okay. So in other words, if they have a land contract, let's just say it's a delinquent land contract, they could reach out to the borrower and said, hey, I'm going to convert you if you'll pay current, let's get this loan current. I'll convert you to a note and mortgage, but I'm going to raise your interest rate. If they do any adjustments to those original terms or the current terms, then they would have to have it.
That's correct.
Certified under the SAFE Act.
Exactly. Yeah, that even goes for loans that were done before Dodd-Frank. So if they're done before Dodd-Frank and you modify it or you change, whatever, there's no requirement that you have to have it underwritten. If you up the terms, if you up the ante, the borrower's coming out of pocket more money per month, now you're under the requirement to determine ability to repay.
Okay. Russ, can you tell us the difference between a QM mortgage and a non-QM mortgage?
QM versus non-QM. So I'll start by saying that we have yet to see a qualified mortgage in underwriting.
Well, that answers my question.
But that's okay. That's okay. There's even I was just kind of thumbing through today some of the CFPB's recent documents, and there's a one-page document that just hit the web that says, you don't have to originate QM loans. It's okay. You can originate mortgage loans that are not QM. QM, qualified mortgage, means that by definition of Dodd-Frank, you're at or below 43% back-end debt-to-income ratio. That's home mortgage plus the new mortgage loan plus all debts. Your amortization is 30 years or less. You have no special features, no balloon, no interest only, no neg-am, and you're away from crazy loan features. So that's basically what a QM is. Non-QM is everything outside that box. Well, Russ, my borrow's at 43%. I meet all these things. I'm a 30-year fixed loan. I haven't charged points and fees that are above the threshold. Am I a qualified mortgage? Because I'm concerned because my interest rate's going to be 11%. So the interest rate doesn't determine qualified mortgage versus non-qualified mortgage. There's no cap. Dodd-Frank doesn't cap you on interest rate, doesn't cap you on debt-to-income ratio. What it's saying is that you can be a qualified mortgage. You can just be a high-cost qualified mortgage or a high-priced mortgage loan. That has to do with how much higher is your interest rate than what Fannie's interest rate is. If you're 3.5% higher, on whatever given day that is, you can go on the web and find out whatever today's APOR is, then you're a high-priced mortgage loan. If you're 6.5% higher, you're considered a high-cost mortgage. Can I still do that loan? Can I still create that note? Absolutely. You just have other considerations. In other words, it's one quick example. On a high-cost mortgage, say today's Fannie's street rate's 4%. And you're going to do your loan at 11. Well, you're 7%, so you exceed the 6.5% threshold for a 6.5 or for a high-cost mortgage, HCM high-cost mortgage. You can still do that loan. Just a couple of features, and one of them is the borrower has to do homeownership counseling before you close. And so we instruct our investors on how to do it. So you see what I'm saying when I go back to just because you hire an RMLO, if they don't know all of these things, just because you hired an RMLO doesn't mean that you're compliant.
Okay, perfect. So are there any credit requirements? Do they look at credit when you're seller financing? I know the underwriter is going to look at credit, but if you have somebody with a 480 credit score, they could still qualify.
Great question. Yeah, we recommend 500 and above, only because FHA requires 500 and above. Have we done loans below 500? Yeah, sure. When there's a common sense life event, things happen, people go through things. We just want to make sure that, again, that borrower has the ability to repay. And so on every loan, we'll always verify recent rental history, how much higher is the mortgage payment going to be than the rent payment. Can these people truly afford? If there's nothing good on the credit report, we'll build credit, 2 or 3 different trade lines for 12 months, auto insurance, daycare. We'll build credit history to show that these people are capable and willing to make payments back to creditors.
Good deal. Well, ladies and gentlemen, thank you. Ladies and give them a hand, please.